plan for today. We're not in communication with her. So we are going to try something a little bit different. And Bill Lee from Mass Prim is going to sit in here as our questionnaire, as our moderator. And Mike McGarr is going to get to the question. So welcome, everyone. Sorry for the late start.
All right. Thank you, everyone, for coming here. This is a little bit surprise, but yeah, I feel like between the two of us, Mike McGarr and me, and people here in the room, hopefully we'll be able to cover a lot of the topics. And maybe to give everyone the context, how this started. Private equity has been always a popular topic among asset owners and investors. But it's not until probably the recent years, there's an even more talks. And also in other communities other than the conventional institutional asset owners. So like 1 month ago, I was here in the same room and there was a consultant who's been covering the retail distributions and such. So there was one chart that was pretty telling. That was I think I expected that, but it was even more that surprising. Is that the reverse inquiries by wealthy individuals to their advisors on this very topic of private equity has been more than doubling. And that's just like a wine lens to tell us about the interest or the buzz.
A lot of interest, a lot of growth. The industry's grown by leaps and bounds.
Right. Maybe to give everyone else another context, both Michael and I work at Masspring, Massachusetts Pension Fund. When I started at Masspring roughly 8-9 years ago, and by the way, I cover hedge funds. The allocation to hedge funds versus the allocation to private equity were almost on par with each other, like 9 to 12%.
That sounds right.
Fast forward, almost 9 years later, like what's the allocation percentage to private
We're
equity?
about 17% of our total portfolio, so it's about an $18 billion private equity portfolio made up of limited partnerships and co-investments.
Versus in hedge funds, we are roughly 8 to 9 billion. So that's kind of another angle to look at the pickup in interest, not only by the earlier case wealthy individuals, but also by institutional investors who have been playing in the same ground for decades. So that highlighted the context, like why we're starting this series of private equity a series. And for today, we're gonna have that intro, and have no doubt that some of us are not strangers to this asset class, but the landscape has always been fluid. It's been evolving a lot. So for this first session, our interview, and possibly Sarah Samuels, who's a major partner at AEPC, will join us as well, is to talk about the evolving landscape of private equity. Versus there will be a couple of other interviews down the road with GPs, general partners. I think that's one of those lingos in the private equity world. And Michael McGarr will be interviewing some of the very notable GPs in town and also from out of town. So, Michael, would you mind maybe, take a step back, giving everyone else introduction,
Sure.
yourself,
Yeah, happy
the
to.
background?
And this is sort of plan B here today, so, please jump in with questions, thoughts, anything would be great. So I'm Michael McGarr. I'm the asset class head for private equity at Mass Prim. Mass Prim is our state pension plan in the state of Massachusetts. So it's a very large defined benefit pension plan. And as I mentioned, private equity is about 17% of total. It's about $18 billion in NAV. So it's a big, mature program in terms of size and scale. I've spent my entire career in, on the LP side, the limited partner side of the private equity industry. This is my 11th year at Prim, believe it or not, which is crazy. So I'm also now a pensioner, so vested into the pension plan, which I'm very proud of. And before that, I was an investment manager at Bain Capital, and I was also a portfolio manager at another state pension plan, the Minnesota State Board. So that's my background. I'm a CFA charter holder and also a graduate of the University of Richmond, and I went to business school at Cornell.
Like briefly about me myself, I also work at MassPrim, the state public pension plan, and very specifically, I cover hedge funds. But nowadays, hedge funds are everywhere, so that means there's been increased interaction and collaboration among the asset class teams, and also because of that, I got to have like a sneak peek into the private equity world. That's a world that hedge funds, some of the very notable hedge funds, including Tiger, Coatue, and such, have been trying to break into as well, with varied success though. So I go like off this question list a little
Sure.
bit.
Yeah.
Maybe like, what's unique about private equity that's so hard for even an adjacent asset class expert to break into?
To break into, you mean like in terms of getting a job in private equity?
In terms of getting a job or getting deals or even getting a fund
Yeah.
up the ground running.
Yeah, I think, a little bit of historical context is important, at least in terms of how I was taught about the private equity industry and how it's evolved. I don't think it's that old in the grand scheme of things. You can think about kind of the oldest private equity firms, whether that's KKR or in venture capital, it might be Sequoia. These are firms that kind of start originating and taking shape in the 1970s, late 1970s. So institutional investors, primarily endowments and foundations, were probably early investors to support these sort of alternative investments, as they were called. And along the years, kind of the term private equity has grown up and, kind of describes almost everything. It's kind of a big tent to put everything that's really not public equity. So when I think about what is private equity, you can kind of define it by what it's not. And in terms of private equity, or excuse me, in terms of public equity, you think about a listed share. It's exchange traded. You can go, to your online broker and purchase a stock of Amazon or Facebook, whatever. Private equity is really just interest in small businesses or private businesses. I'm sure many, in the audience, business owners, whether it's, the local coffee shop or, a consulting firm. And your ownership in that business is, private equity. So this entire ecosystem, this industry has sort of formed over time and has grown, by leaps and bounds. But I think that fundamental just equity ownership is key. Why is it so hard to break in? I think a lot of that has to do with, how the industry was formed. I think we're very lucky in Boston. We're some of the oldest private equity firms like TA Associates or Advent International. And a plug for one of our upcoming series. We have one of the managing partners from Advent International who's going to come in and he's going to, talk about his business. But for one reason or another, private equity was, very, very early in kind of Boston, New York, and some other industries. And it stayed largely under the radar for many, many years. So you don't need an, enormous number of people to execute a private equity strategy. And when you talk to, these professionals, the general partners, as they're called, really what they have to do is they have to convince this kind of broad set of participants if you're buying a business, you're buying a business from probably somebody who built it, has worked there every single day. It's probably their baby. That's a really important decision in terms of who you're going to sell that business to. You might be funding the purchase with debt. You got to bring kind of the lenders along, let them, understand the situation, why you're buying the business, at what price, what valuation, et cetera. And then what are you going to do once you own it? A key feature of private equity is control, especially in buyouts. Usually you're purchasing the whole business. So I know that's how, very famous investor Warren Buffett likes to think about, businesses. What if you're buying the whole thing? What would you do with it? And why would you want to own the whole thing versus, a small piece? So I think that is part of the reason why it's tricky. You can't just, anybody can kind of go online and buy a share.
Right.
But I think to, really buy a $100 million business or a multi-billion-dollar business, you have to have credibility. You have to be able to work with lenders. You have to, understand how to own and can operate a board of directors. So there's a lot of components.
So it's not like a day trader who can easily execute on a daily, if not minute by minute basis.
I don't think so. I think it's a very different skill set. We've talked about this with kind of the hedge fund world where you're kind of engaging with the terminal and you're trading versus in private equity, you're managing a company, you're leading people. You have to engage with, customers. What's the appropriate dynamic on the board of directors? What's the right direction? Is it Tom?
Yeah, it's the, how we always call it for public stock, it's a limited liability stock company. In private equity, are there liabilities for the owner operators that go beyond what the initial investment is, or how does that work?
Typically, so the underlying holding companies can be structured as LLCs. Oftentimes, they're not structured as C corps because of the double taxation. They prefer to have them be pass-through entities. And then in terms of, organizations like MassPrim, when we're investing into private equity, typically what we're doing is we're committing capital to these limited partnerships that are formed with a distinct purpose to invest according to a particular strategy. Those are limited partnerships designed to limit liability of the underlying investors. Now, the general partners have general liability because they're owning and controlling the fund, which then owns and controls oftentimes these businesses. Does that answer your question, Tom?
So I'm understanding, Michael, the complexities in sourcing, in operating, in structuring, in working with the board and the private equity setup. But if to look at this from afar, it's essentially owning equities of a business. So in that regard, there's also overlap with the public equities, which is also at the end of the day, owning a piece of a business. So, I mean, again, aside from the operational complexities, like where do you see the difference, or do you even think there is a diversifying angle, for whoever's already investing in the public arena to go into the private arena?
When I first started my career, there was, I think, more of a perspective that private equity was different. It was a different asset class, it operated differently, and you needed to evaluate it entirely differently. And I think as the field has emerged, gotten more sophisticated, I think people appreciate that it's just a different type of equity. But so many of the tools that we can use in public equity investing, you can't really use in private equity. So something as simple as volatility, we don't really have the same volatility measurements in private equity because we don't have daily prices. So we don't have a mean and a variation around those daily prices. So there's other ways to, interpret and understand the risk associated with private equity, but it's kind of trying to bridge that common language between illiquid and liquid. And, if you think about a business owner, if you, own and control a business, do you care what it's valued at that particular day? You're probably not going to sell it that particular day. So really, you only care about what the value is when you sell it. So I think that's a big distinction.
So, I mean, we don't get to observe the day-to-day price movement of private equity. So do you think that provides like a natural diversification? Because like, basically, every morning I wake up, I look at my private equity investments. It's probably the same as valued as yesterday. Whereas public market is being like volatile,
Yes.
get up and downs. So from that angle, it's diversifying, each other. How about from like business cycle angle? How about 1 year later? I wake up. That like,
So I think it's a really interesting
to year.
debate. The first part of your question, Bill, is, you're not valuing these companies every day. So what's the price versus the market, which is, providing you a market clearing price to buy this, small share in this business. So private equity doesn't have that. Is that a feature or a bug? I think, people will debate that and saying, well, you're not really recognizing what the true value is, whether it's up or down, and you're not recognizing that volatility associated with that. So that's clearly a bug. That's a problem with it. And then other institutional investors will put that together. And I think the reality is you have a smooth return stream that flows through your portfolio. Maybe that's a feature. And I think you could flip that argument on its head and say, is the public market perfectly rational? And is it pricing things perfectly in 2021? And then is it pricing things perfectly in 2023? And I think that's debatable.
right, be just noise.
Now, private equity won't go up as high, but also won't go up as low. And that's sort of the smoothing pattern that you observe. Now, the other part of your question about why is it really just owning public equity in these illiquid formats? And there's some of that, right? There's some publicly traded companies that are held in these, partnerships or portions of them. That's a very small portion of the, think about a company that just went public. You'll still own those shares in the private venture capital firm or something along those lines. But by and large, I think you're talking about different universes. You have publicly traded stocks. These are Coca-Cola, Amazon, huge, enormous businesses. And then private equity, by and large, is small businesses, very small, oftentimes under $1 billion of total enterprise value. So think market cap, probably $600 million market cap. And oftentimes if those small businesses are, taken public, there isn't a tremendous amount of liquidity in those, smaller stocks. There's not a lot of analyst coverage over them. So oftentimes it's really distinct universes. And access to the small businesses, I think that can be diversifying because you just have a different segment.
So in that regard, it's even though both public and private equity ownership of businesses, underneath the hood, the nature of those businesses differ. Is that like what you think is the diversifying like benefit?
I think there are some differences. I think size, certainly. I think if you look at the underlying, sectors, like private equity in some ways has a better glimpse into the service economy of the US. And, if you think about, small consulting firms, accounting, law firms, those are all private businesses, whether they're owned by private equity or not, but oftentimes you won't see very, very large, corporates.
Right. Very few of them are publicly traded yet. They can be still very lucrative businesses.
That's right.
Right. And I guess now it's also almost time for me to yield the floor to
Yeah, should
Sarah.
we call an audible here and call up Sarah Samuels for some additional questions?
Yes. So
Thanks for pitching, Bill.
yeah, of course.
Really
Okay,
appreciate
this is fun. So basically what we've talked so far is what is private equity, what's unique about private equity versus public equity, and also the very debatable topics. Are they really the same type of investments? I know there's, two sides of the argument in terms of the volatility and ownership. We're merely scratching the surface. Without a further ado, Sarah Samuels, and I'll let you to
Thank
dig
you.
deeper into this interesting topic.
Thanks, Bill.
Yeah, so Sarah, why don't you kick us off with a brief intro?
All right, thanks, and thanks for your flexibility with my tardiness. I'm Sarah Samuels. I'm a partner at NEPC, an investment consulting firm. We are advising on $1.6 trillion of institutional capital, and we invest about $120 billion in full discretion for our clients. We are putting about $8 billion into private markets each year on behalf of our clients, and we have about $150 billion in the ground. So I oversee the team that selects investment strategies across all the private equity, private real asset, private debt strategies, as well as hedge funds and anything publicly traded. And I had the good fortune of working with both Bill and Michael at Mass Prim, where I was there for 6 years, that we had several years of overlap. And Michael and I it's really cool to see this come full circle because we have spent a lot of time together. My origins were in the public markets, and then I spent time with Michael and learned how to invest in private markets. And then from Prim, I went to Wellesley College, which has a huge private markets portfolio. So Michael and I actually spent quite a bit of time trying to unpack what the differences are between publics and privates to create a common language to think about public markets and private markets, because a lot of times teams can't have fruitful conversations because multiple uninvested capital or IRR is different from how you think about public market return. There's also a lot of mystery around private markets, which there really doesn't need to be, but it takes a lot of work to break down these silos. So yeah.
That's a great intro. Thank you. And we've covered a little bit, so I'm going to jump around here a little bit, Sarah. But maybe you could just describe kind of what does the PE landscape look like? PE is a broad term. The strategies are really, really different. So tell us about how you think about it.
Absolutely. So we often use the term private equity to refer to anything that is equity oriented as opposed to credit or real assets. And so for us, we break it down into three main areas, which would be venture capital, which is investing in companies as either an angel, pre-seed, seed, Series A, Series B investor. We break it down into growth capital, which is growth equity. It could either be later stage venture capital, like a Series E round, or it could be a hybrid. Growth is really nebulous and poorly defined, growth equity. And so it could be something where it's more akin to a buyout strategy, where a GP is coming in and taking a control position, but not buying the entire company. First institutional capital into historically bootstrapped companies. So that'll be more on the growthy side. And then we look at buyouts. And I think you've already talked a good amount about buyouts. Lower middle market buyouts, middle market, and then mega are kind of the way that we think about things. And then there's a whole slew of other stuff. Fund of funds. That applies to venture capital as well as buyouts. And that can be a great solution for investors who are LPs who are just beginning to dip their toes into private market waters. There are secondaries, which are another great tool, portfolio construction tool for secondary funds for investors who are just starting. They can mitigate their J-curve effect, which is pretty painful for investment committees and staff alike when you're starting to put dollars in the ground. And then we're seeing all sorts of new stuff like continuation vehicles and other
Fun stuff.
areas like
Yeah.
that. Yeah.
Yeah. Financial innovations.
I can call it that.
Yeah. So tell us a little bit, you have a very broad perspective, across, working with lots of different clients. I know you're the chair of your alma mater.
Yes.
Is that right?
Mhm.
And do some private investing as well. How does your perspective change when you're looking at it from kind of investment committee level, on the ground, making, an individual investment for myself, or I'm managing a team and helping guide a team?
That's a great big question. So I think anybody who is going to be investing in an area, if it's at all possible to be a personal investor yourself, it pays off in spades. It could be small dollars, but if you're an equity investor, I encourage you to buy a stock and see how it feels, right? To get those muscles moving and understand the behavioral biases that might exist. And what we need to be looking at. So for me, a few years ago, I started angel investing, and I've learned a lot about terms and structures and investing in private markets and building companies from that, which has really helped. But when we're bringing something through to an investment committee, I've done this at Wellesley, I've done this at Prim with you, and done it at UNH, and then of course all of our clients at NEPC. Many times there are going to be people there who have different degrees of understanding about private markets. Especially in the last few years, many LPs have really backed up the truck with their private market allocations. They've gone through the roof. So we use this education deck to bring along our investment committee members. Board members are even further removed oftentimes from the nitty gritty of the investment process. So this is a really interesting skill required where you need to understand what the GP is doing on the ground to fully be able to evaluate if they're skilled, but then lift up like 100,000 feet for a committee presentation.
And when you're advising clients, like what is the role what is its purpose? What role is it playing in your portfolios?
Yep. So private equity is becoming an increasingly large part of the capital markets ecosystem. So and we all know the statistics about the number of companies that have decided to stay private for longer. So there are lots of great companies out there that are private. We also believe that, number one, equity markets go up over time. And number two, an illiquidity premium does exist. So it plays an important role in a portfolio because many clients out there today need higher returns than the capital markets in the public markets sphere can give them. We're looking at 4 or 5% expected returns for U.S. equities. And most of our clients have a 7 or 8%, maybe 6 to 8% nominal return hurdle each year to pay out their beneficiaries or to pay for the students at the college, the operating budget. So they need to do more. Private markets, we've found, can be diversifying. Michael and I did an analysis of the enterprise value of these underlying companies and found that they're much, much smaller on average than what you see in the public markets. And then some clients, this is flawed logic, but they appreciate the lack of volatility because it's not mark to market daily. If it's a corporate pension fund, that lower volatility can be truly beneficial from an accounting perspective, but just know these are incredibly volatile investments. And this is the only instance in the capital markets. I think it's important to think about it from a total portfolio context and not just, private equity returns 18% net IRR. There is a tax on the rest of the portfolio for that. Nobody ever considers it. You have to have that capital liquid and ready to go, and it's called by a GP. So this is the only instance in the capital markets where you're short a call option and you're paying a premium to be short. So I think it's important to just think about that when evaluating the track record.
Need to have that capital available in case it's called, otherwise you're going to be in trouble.
Yeah, don't miss a capital call.
Yeah, don't want to miss capital calls. So another thing that you and I worked on at Prem years ago was just industry level dispersion. Can you chat through kind of what you see across different asset classes, and especially in the private markets?
Sure. And we're talking about return dispersion within universes?
Yeah.
Yeah, so many of you are probably familiar with the candlestick charts, which are just a dispersion metric. You can look at the 5th percentile, 25th percentile, 50th, 75th, and 95th for any given universe. So that's easy to get in public markets. You can go into investment and run it. And if you're really lucky in public markets, you might have 4% dispersion between the top quartile and third quartile. In private markets, what we see is venture, the dispersion between the best and the worst manager is upwards of 45%, 50%.
So 10 times greater. That's crazy.
In buyouts, it's actually not much smaller than you'd think because venture is supremely risky, right?
Mhm.
But in buyouts, the spread between the best and the worst GPs is also 35, 40%. So what do we take away? You can't just buy beta. There's no beta option to invest in private markets. And there really isn't, an option except to go active. And the decision of which GP you select makes a huge difference.
And what are some ideas on why that dispersion exists? Like, why are some managers, 400 basis points, 4,000 basis points greater than another manager, presumably doing the same thing, charging the same fees?
Yeah. So I think that higher fees, the higher fees that private markets strategies command, 2% and 20%, or some combination of that. Some even have premium fees, which are higher than that. This is going to attract a lot more investors on the GP side to create funds and to collect those fees. And so it reminds me a little bit of the halcyon days of hedge funds, when it was kind of like shooting fish in a barrel. You launch a hedge fund, you're going to become a million or billionaire. So lots of people are trying their hand at investing in private markets, and they're not all great. The other is that there does seem to be a bit of a halo effect, especially in venture capital, where the best founders go to the venture capital GPs with the best reputations, which in turn gets them better founders, which in turn improves their reputation. And so that's a little bit of the effect there. But, there's a lot to learn in running a private markets fund. So it's not just about, picking a company and cutting costs and then exiting. You have to understand how to structure a portfolio, how to manage risk. You have to understand whether you want to have reserves for follow-on investments in a venture portfolio, or just, have cross-fund investments. So there's a lot of folks who have a time period where they're learning, they're in college, but we don't want it to be on our dime, right? We don't want to foot that tuition bill.
I want to make sure that there's plenty of time for Q&A. Before we jump into Q&A, where's the market headed? It's been a tough couple of years for private equity, I think, compared to kind of a very lucrative boom years of, call it 2013 through 2021, maybe. So big bull run, and there's been a reset. Rates have gone up, transaction market slowed down. Where do we go from here?
Mm-hmm. So our view is that in buyouts, anything that relies on buy and build, which means acquiring lots of companies with zero interest rate costs, isn't going to work, because the margin for error now going forward is not there with the higher cost of capital. We also are wary of exit activity until valuations reset more. So there's a disconnect between buyers and sellers, except for the highest quality assets. Those are the only things that are transacting today. In venture, be aware that last round financing is the preferred valuation methodology for many venture managers. What does that mean? It means many of these portfolio companies are being held at valuations that were at the peak in 2021 or 22. And until they raise again, they're going to continue to hold these high levels. They're going to need to raise at some point or fold, and that's when we think a reckoning is going to come for venture managers. What LPs are really struggling with is lack of distributions. This messes up your pacing model. It messes up your ability to fund your obligations, as well as capital to redeploy. And we think this is a great time to deploy capital into private markets. It may feel yucky, but this is some of the best.
Managing that cash is critical.
Mm-hmm.
Question, Mike.
Yeah, so along those lines, do you have a view on continuation vehicles?
They're great for the GP.
What is a continuation vehicle?
Yeah. So a continuation vehicle is a special vehicle that's set up for either a single asset or a portfolio of assets that GPs create for a couple of reasons. One might be that they're running up against the end of their fund life when they need to begin to exit and liquidate their positions. They run up against all their extensions. And so they create a new vehicle and fold that investment in there. But we're also seeing lots of GPs create continuation vehicles so that LPs can get partial or full liquidity. So what they'll do is say to an LP, we're going to keep this asset because we know it's good and we want to invest in it for 20 years instead of 14. And you have the option to take liquidity on this with a haircut or roll your position for longer into the continuation fund. They do continue to collect fees on that vehicle. And, I think that the jury's out as to how it's all going to pan out.
Great question.
Yeah.
Yeah, Bill.
There's many good things about private equity, the dispersion, the proven higher returns. For folks and organizations who want to now allocate into private equity, it doesn't seem straightforward to execute on that. Can you talk more on that? How you would advise your clients in allocating into private equity, especially those who's still, new to this game?
New to the game. So we start off by doing an exercise to understand an investment committee or governing body's risk appetite. And oftentimes it's super dispersed. So someone might say our long-term time horizon is 1 year. Some might say it's, 20 or perpetuity. So we try to get everyone on the same page philosophically before we even begin. And then we try to understand based on that their risk appetite. And from there, we will look at some proposed allocations. If someone has a lower risk appetite or they're newer to the asset class, we might do something like 60% buyouts and 40% secondaries. And if they're more open to risk and at that other end of the spectrum, we'll do 30% venture, 30% buyouts, and then the remainder in a little bit of growth and secondaries. And if you're talking about a blank slate, then I think doing a fund of funds or something to just understand a little more and get a little more exposure to diversified investment in the ground right away makes a lot of sense.
If you don't mind, maybe from another two angles, the former question was for investors, allocators. How about for hedge funds who want to break into the space? And how about for individuals, employees who want to break into the GP world?
It's a huge trend right now with the democratization of alternatives. It's been going on for a couple of years, but it's really taken on a lot more momentum recently. You've got all kinds of GPs attacking the private wealth and more specifically the RIA market, so not even the ultra high net worth. So I think it is more available than ever to invest in these things. One thing that I always caution people to be aware of is to make sure that the liquidity of the underlying investments in whatever private market fund you're investing in is not less liquid than the fund itself. We don't want to run on assets because the terms allow for it, but the things can't be sold. That's a big issue that I think is overlooked in a lot of these funds. And then from employees.
Right. There's
hedge funds, yeah.
So firstly for hedge funds, who's migrating to the private world because it's locked down capital for longer, more lucrative fees. So that's one question. Another question is, there's recently a survey on the newer graduate students and also as well as undergrad students. Now private equity has been talking their dream list to break into. Like any advice there? Those are like two separate questions.
Okay, so hedge funds, again, they're going to follow the fees, and it's a great structure for a manager to have a fund where they can lock up capital, have limited transparency, and charge high fees. Better make sure they understand what they're doing in managing a drawdown vehicle. There's a lot more to it. It's different. It's different than having a side pocket set of investments. The next question was about.
Like for students.
Students, yeah. So anyone who aspires to be in private markets, venture is an apprenticeship model. So find yourself a venture GP who you can get in close with and try to get an internship and maybe a job there. They're going to look more for tech backgrounds or sometimes you can go from being an operator at like a Facebook or a Wayfair or something and make your way into venture, or you can start from the financial side of things. This is much more of a network where, it's like, do I have a connection to get in with this venture manager? Unfortunately, there's not a CFA equivalent for venture that can prove that you're smart, and we're working on getting it more on their radar. With buyouts, it's an investment banking story. You've got to do investment banking for a couple of years and then go back to school, and they want you to have those modeling skills if you want to work at a GP. There's a consulting, sorry.
There's a question online from Jerry. Jerry, if you want to unmute. Okay. If not, he asked, how should an asset owner deal with the challenges of selling PE positions in a timely manner or the lack of distributions?
Great answer.
It's a real challenge. I think sort of planning to be able to sell private equity interests to satisfy portfolio needs is sort of setting yourself up for failure. I think you have to go into this asset class understanding the illiquidity and having an approach that is able to weather kind of a long hold period. Now that being said, there is a very large and growing secondary market. So as Sarah mentioned, you can sell a limited partnership interest, a co-investment, or into this GP-led continuation vehicles that we've been talking about. So there is an active market, but it is, I think, smaller, less liquid than the primary private equity market.
Yeah, and I've done a big secondary sale where we sold a huge chunk of the private markets portfolio, not with Michael. And it took, I mean, probably 5 months of 100% time focused on it. And we took a pretty decent haircut because we had some venture and stuff in there that gets a bigger discount. So there's about a 20% haircut to the NAV. So it's not something you ever want to do. But if you can prove that your opportunity set is going to give you a better return than what you're getting rid of, then you can make a case, but you're going to pay fees. There are brokers for these transactions. And then there are some others out there who are kind of providing liquidity to LPs in a more creative and structured way, where they'll sort of say, we're going to take on this investment for you and give you the liquidity. Not necessarily a co-invest or an exit situation. There's getting more creativity, but I think it's hard. The best thing you can do is speak up and let your GPs know what you're working through and the challenge that it has for you. I think there's a big disconnect in understanding between GPs and LPs. So both sides think the other is maybe we don't understand their perspective. So LPs think venture GPs don't want to sell because maybe they want to hang on to something longer and make more money. Venture GPs don't understand that LPs and buyouts too, that LPs have, it's not just a buyout or a private equity portfolio in isolation. That's not 100% of our assets. They forget that we have a whole rest of the portfolio to manage. We have an expected return target, we have a governing body, and we have stakeholders that we need to pay money out to each year. So the more we can educate each other, then I think that's really helpful.
Education's key, and that's a great segue to think about what the purpose of this private equity series is. Maybe you could, well, we could pull up the agenda for future series, but tell us, why are we doing this? What's the purpose?
And I think, Bill, you're the champion, right? Do you want to take?
Yeah, we kind of started off with this context that, for why there's more inquiries, even by, wealthy individuals as well as other individuals to their financial advisors on this very topic. So because of that, there's a pickup in interest also among the CFA charter holders to learn more about private equity. So that educational angle is very important here. But even outside of the RA arena, institutional investors are also seeing pickup in interest in allocation to private equity, but the level of understanding of knowledge really varies, from people to people, from stakeholders to stakeholders. So, we're also trying to provide this, platform to, those folks. And later on, we will have other sessions to interview the general partners, growth equity, venture capital, and such, as well as buyout. So those are also to engage the GP side of the practitioners to tell their side of the story, how they really operate, how they source deals, how they manage the board and the exits. And those are the on the ground experiences and lessons that we hope that they are shared also with us, the CFA public holders and members. So there's a lot of goals kind of packed into this series of behind closed doors. But I think this is a great start.
Boston is really rich with resources and experts in private markets. On the LP side, there's a wonderful endowments, really smart people here, and one public pension fund in particular is really smart people. And there's lots of GPs. So this is a great community to be doing this in, as opposed to some of the smaller CFA societies in other parts of the country.
I'd like to know more about the conflicts that you have in pricing and how do you try to solve them?
Meaning the valuation policies?
Yeah, maybe for venture capitals, because we saw a lot of same venture capital firms doing several rounds for startups and marketing them like doing several years. And maybe there's conflicts in private equity as well. Like to know the conflicts of pricing. What you guys think so that has an LP perspective?
Well, I think Michael probably has a lot to say about this. What I will say is that valuation policies are a huge part of our underwriting process. We have an investment framework with 400 questions, and the valuation policy section is pretty dense. There's a lot of guidance out there, but it is much less regulated than something like a public market valuation methodology. So we've seen venture GPs use last round financing. That's the most common. You can do transaction-based comps in the public markets, or we've even some used an options pricing model, which is pretty complex and hard to understand. Furthermore, they can change what they're using from one time period to the next. Their auditors are going to sign off on it. Auditors, for some reason, are less open to marking down. There has to be a really good reason, so preemptively marking down. But you might also notice venture GPs, they can invest in the same portfolio company in the same round and hold it at a 50 to 60 to 70% delta. The same company, they can hold it at vastly different values. So there are conflicts from a fundraising perspective. If you mark down and do the right thing, you may not raise your next fund. But
There's lots of conflicts, and I think alignment is critically important in the private markets. And we're talking about conflicts between maybe, investors and LPs and GPs. But then there's also employees, especially in the venture community, where the stock options are a really important part of it. So valuation rounds and whether valuations are going up and down can create kind of different cost bases associated with investors and employees, managers in a particular company. That's a great question to ask during our growth equity session, because oftentimes those growth equity investors are coming in after the early stage Series A, Series B investors. They're coming in, company is a little bit better formed, has customers, has revenue, and oftentimes there's a real business to analyze as opposed to, hey, I've got a great idea, a new technology, but I don't have customers, I don't have revenue, I certainly don't have earnings. So I think that dynamic and that alignment is critically important to get right.
and you made me think about a big misalignment, which is when you've got a seed stage investor, often they don't stick around until a growth equity investor comes in. But if you've got sort of a Series A investor and then a Series D, they're going to have come in at very different times in the decision as to what to do with that company, because they'll sit on the boards. They're from very different starting points. So there's a
Different
lot of
perspectives.
conflict between the late stage investors and the early stage about what to do with a company. Is it time to exit or time to keep going?
Ted has a question online. Ted, you want to unmute?
Sure. And these probably aren't short ones, but what is the outlook for the democratization of this market? How can you package illiquid markets in an ETF? You've got several of the large financial service companies who are partnering to create these retail-friendly products. And also, would you care to comment on the Jared Dillon report that was released yesterday, basically calling private equity a bubble market?
Yeah, I haven't read that report. I can't comment on that, but I'm going to read it now that you put it on my radar. I would go back to the point I made earlier that you never want the vehicle to be more liquid than the underlying investments. That's a recipe for disaster. We've seen it with lots of hedge funds in our past, and it's not a good outcome.
Buyer beware.
Is it concerning that so much money is now coming in at the retail level? Just as with hedge funds, everybody wanted to be in them. A lot of bad managers got in, money came in, and it all got washed out in the great financial crisis. Is there the potential we see something like that here?
I think certainly there's the potential. I don't think it's good or bad in terms of, flows of different types of investors. I love the idea that there's, more people able to analyze, understand, and invest in the asset class. I think, if you think about the Securities Act of 1933 and why we have the SEC, it was to sort of protect, individual investors. I think the private markets is largely outside of that regulation, and people that, jump into that area that aren't equipped, that don't understand the illiquidity, that haven't planned appropriately, you could get into trouble. So I worry about that as, kind of the negative side. But, I don't think that, these asset classes should just be available to, select types of institutions. That doesn't quite seem fair.
Yeah, and as you know, our theme last year with CFA Boston, when I had the pleasure to be chair, was really focusing on lifting others up and improving the voices in the room in the investment ecosystem, but really underlying all of that is the wealth gap. And a big part of what perpetuates the wealth gap is that the wealthy get to do these investments with each other that continue to, make them wealthier, and then they pass it along to their friends. So buyer beware is absolutely right. If someone has the ability to parse